We previewed the show with looking at Simon Property Group. Would you like to fire that up as the announcement's over? Let's get after it here?
So Simon Property Group, guys, is a mall owner and operator. So I want to sit there and describe it right here. They currently own 207 properties, 106 traditional malls, 69 premium outlets, and 14 Mills centers. I have no idea what that is. It's a combination of traditional mall, outlet center, and big box retailer. Malls have been struggling lately. I went to the mall this weekend. Did you go to the mall this weekend?
No, I had a wedding this weekend.
Dead.
It
looked like a regular weekend on a regular July afternoon.
Oh, that's right. It's December. That's where you're going with this. Usually it should just be jam-packed.
No jam-packed. Parking. 18 is like wall-to-wall cars during the winter, during Christmas time.
Yes.
It was dead.
What were you doing there?
Mikey was dropping off his computer over at Apple Store to get fixed, and we went and bought some gifts for some family members. And
some lingerie for yourself, I assume?
Yeah, I don't buy those in public. I do that online. Internet sales are going to keep creeping up and increasing over time. When I left college, internet as a percentage of all retail sales was like 1.5%. It's now over 15%. So you've got to remember that malls are going to transition. Now, usually people overreact to news. Will malls go away completely? I doubt that. Will they find other uses for mall? Absolutely. Look at, there's a couple malls locally that were bought that are dead malls. Amazon went and leased them, and they're now being used as Amazon fulfillment centers. They will have other uses. The question is, do you think malls in general are going to do very well? Now, the one thing I do like about SPG, they only have 207 properties. That's only 4 per state. That's not a lot. I don't think that's a ton. I expected to see 1,000 properties in here. So it's not a lot. We're also going to look at their debt levels and figure things out like that. But we're trying to look at mall operator and say, are they being punished too much for what's going on? That is the question we have to look at. They also own a piece. Simon's portfolio averaged $693 in sales per square foot per year in the last year. This is a very good stat. You know why? You're going to want to go look at their 10K and figure out what that's been over the last 10 years. See how that's changed over the last 10 years. Is that going up? Was it 750 5 years ago? Now it's 693. Was it 1,000? You want to figure out these things as part of your investigation into the company. And we might actually pull up the 10K here and look and see if we can find that information.
A lot of our patrons are on right now. David's saying markets are rallying right now, just FYI. Trader Mo is on there answering your questions alongside us. We love having him as a friend and consigliere. So, Paul, keep going. You want to start getting through the pillars on this puppy?
All right, guys, let's start. So first off, let's look at the market cap. It's about a $30 billion company. So if you want to buy all the shares, you have to pay about $30 billion to own all the shares of the company. PE, 20.3. It's technically an X, very close to 20.
Very close.
But we also have to wonder, in my head, I immediately go, well, how much of that is a drop in revenue over the last 12 months? Because I'm sure they've lost a lot of revenue over the last 12 months because of stores going out of business or them saying, hey, we can't pay our bills, can we extend, et cetera. So 20 is an X. Now, profit margin, 13.84. That's the last quarter. Not bad. If you actually look at the last trailing 12 months, it's actually 27% on the profit margin. So definite check there. And their gross profit is almost 80%. Definite. There's no check there for that one, but it's a good gross margin. So far we have 1 X and 1 check. Still not bad. Real estate has an expense called depreciation. What that is let's say you buy a building. The government lets you take, let's say you pay $1 million for a building. The government lets you take roughly $30,000 a year as an expense on that building for what's called depreciation. You don't actually pay the $30,000. They let you write it off the $1 million of that building's value every single year. So the depreciation is an expense, and it's counted against your profit, even though it's not cash out of your pocket. So we're going to look at this cash flow as being important as part of it, and we're also going to look at the net income and look at depreciation. And by the way, big dividend, 6%. Last year, in the last 12 months, it was 7.6, so it's lowered, but it's still a healthy dividend of 6%.
Paul, keep going. Let's get on to revenue growth.
Yep, revenue growth.
Revenue growth is pillar number 3, revenue growth over the past 5 years, Paul.
All right, 3.5 to 5.4. Check.
I hit the wrong sound effect, Paul. I gave the wah, wah, wah.
Well, it is a check, but there is a big thing here. Look at this.
Uh-oh, okay.
There's a big jump here. Something tells me there was an acquisition at this point. Because I have a hard time believing that this big mall operator who owned a lot of properties all of a sudden had their revenue on long-term leases jump up 40%. I doubt that very much. So there was probably some acquisition that happened here. So over the last few years, as you can tell, very moderate growth, but it's still a check mark nonetheless.
Pillar number 4 is profit growth over the past 5 years, Paul. Profit growth?
Yeah.
What were you going to say?
I was going to make a joke and say, irregardless, it still had growth.
Okay, go on.
All right, 1.828, 2.1, check mark. Now, in a previous video, I started to show a thing called operating income. Now, the operating income will show you how the company itself did from its own operations. It's before interest and taxes, but it's after depreciation. This is a good way to see how the business itself is going, because now you don't have to worry about taxes or interest payments. If a company has very little debt or very high debt, it's not going to affect, it shows you how the company itself is doing. Operating income here, guys, if you look at it, it is growing pretty nicely. Now they did make an acquisition. Wait, please tell me this isn't quarterly. I'm going to shoot someone. Nope, it's not. Good.
Paul, tell the folks real quick one more time. This is sort of new. Why are you looking at operating expense?
Operating income.
Operating income. Go ahead.
Operating income is a way for us to look at the company without any debt and without paying taxes. Debt and taxes are based on where you operate, and debt's based on what you choose to happen. So it doesn't really show, if Seth and I both have a business, the exact same business, exact same market, we both do $10 in profit, operating profit, but I have a ton of debt and he has zero. He lives in Texas, I live in California. We're gonna have very different bottom lines, and it'll make it look like that I'm doing worse than he is, even though as a company itself in operations, I'm doing better.
Make sure you guys are smashing that like. We love you. Keep
Number
going,
of shares outstanding and decreasing, 310 million down to 308. Check mark there. All right, so total current assets, 2.5 billion. Total current liabilities, 3.3 billion. So that's an X there, guys. I don't like that very much, especially, but I imagine probably in this economy with them, it's probably pretty likely. I mean, look at their cash position.
Oh, Chris said this stock is almost 90% institutionally owned.
So what that means, guys, is so many people own it. This is why smaller stocks do better when they're often ignored. A company like this has institutional buying, so it's hard for it to really jump up in price, to get a lot of volume in there to jump up in price. A lot of people care about that. I really don't. To me, I care about the value and what I'm getting. I don't really care if it's institutionally owned or not. It doesn't matter to me.
Pillar number 7 is free cash flow growth.
Okay, so we're going to look at last year as the most recent year, even though this year a lot's happened. So let's first look at the year-to-year basis, and then from there, we'll go do the last 12 months. So year-to-year. Ready, Seth?
Almost ready. Go ahead, Paul.
Okay, 2, 2.5, 2.8, 3, 2.9. So check mark.
Millions or billions?
Billions.
Billions, this is free cash flow, and the average of all that over 5 years is 2.6, Paul.
Okay, now, I am fine with 20 billion times 20 here because of depreciation. That's $52 billion, and it's actually 30 billion. So it seems like it's check marks from the financial aspect. Now, remember also, it was a 6% dividend on 30 billion. That is $1.8 billion. That's a big chunk of their free cash flow, guys. The good news is, in most property companies, that's what they do to pay investors back. They pay the big dividend. So I'm okay with this dividend being such a big chunk of their free cash flow. I'm actually fine with that. And from a financial perspective, it is only selling for, currently, what was the average? 2.6. So it's selling for about 12 times free cash flow. Okay. So if you guys see, the PE was 20 and the free cash flow multiple was about 12. And that's with increasing free cash flow lately. So one of our users before he got off said, malls suck. Guys, are malls in general going to do better or worse over the next 10, 20, 30 years? I think they're going to do worse. But
is this a cyclical thing, Paul?
Well, it's not a cyclical thing. We're having a secular change in the way people buy right now. With that said, there are other companies who are doing great jobs where there'll be other opportunities. I don't think people are going to stop going to malls. It's still a place to interact. Women love going there. I like going to the mall. It's still a fun place to go. Now, the question you have to ask yourself is, so one of the things I want to look at is EBITDA. EBITDA in real estate is very important. It's right here. What this means is
expenses before income and taxes.
Hang on a second. Let's look at the free cash flow for the last 12 months.
Expenses before income and taxes, Paul? Are you surprised I know what EBITDA?
Earnings before income taxes, depreciation, and amortization.
Darn it. Okay, I was close there.
In the last year, the last 12 months, they've had free cash flow still. It's been about 1.7 billion. So it's down a lot, but they still have free cash flow, which is great. You want to see that. Let's see from the quarterly basis how it did. Guys, only 1 quarter of negative free cash flow. Wow. And that was June 2020, which makes sense. Holy cow, that's impressive. Guys, Simon Property Group, I don't think they have, so here's the deal. In real estate, what you want to do is you want to pay a multiple of EBITDA, okay? EBITDA is earnings before interest, taxes, depreciation, amortization, okay? So let's go to the last 12 months. This is going to be a skewed number. Their EBITDA over the last 12 months was $3.7 billion. Okay, there's a thing called a cap rate. What a cap rate is how much return you get if you pay cash for the property. The higher the cap rate, the lower the price, right? So if a property makes $1 a year and you pay a 10% cap rate, you need to pay $10 for it because $1 divided by 10 is 10%, okay? If you want a 5% cap rate, you pay $20 for it because $1 out of 20 is 5%. So the lower the cap rate, the higher the price. Now, let's say malls suck. All malls tend to sell for very low cap rates because they're premier properties, they're beautiful. What I like about this company is they're currently selling for $30 billion. Well, you take the debt out of them. So now we have to go back to now we have to sit there and say, okay, let's take all their, I'm going to skip a couple steps here, guys. Enterprise value. Their enterprise value, that is the value of their company adding the debt back in, is currently $53 billion. Their EBITDA is 3.7. You're probably like, what the heck is this guy talking about? So if I want to buy the real estate all in cash, I have to pay $53 billion for it. Seth, what's 3.7 divided by 53? So 7% cap rate. So right now, this big mall property is selling, their business is selling for about a 7% cap rate. I'm actually surprised it's that high. And not only that, that's based on the last 12 months, terrible profit, because they had a quarter in which they had like no revenue coming in. In previous years, they were as high as $5 billion, guys. $5 billion divided by 53 is 9, what is that, Seth? 5 divided by 53?
Sorry, my friend, I'm watching these ridiculous
Call it
comments.
9%.
Yeah, it is 9.4%, Paul.
9.4, even better. So, guys, I would say this. My opinion on SPG is, if you think SPG is a mall operator who will continue to make their properties the better, or at least keep them stable, I don't think you're going to do bad. Because remember, interest rates right now are super low. They can still borrow money on very low interest rates. They don't have a lot of debt in their properties either. Their properties are worth $53 billion in terms of, the company's worth $53 billion, and their debt is a total of $30 billion. So that's a pretty low number in terms of long-term liabilities is $26 billion. It's about half the debt number. I mean, this is part of the qualitative part of investing. As a real estate buyer, you have to decide, are you going to buy this company? Do you think, if they're a mall operator, is this mall operator going to do very well compared to others?